I do want to welcome in our next guest, though, joining us now, Dale Smothers, the president and CEO of RDS Wealth Management, to talk more broadly about this market action that we're seeing. You know, Dale, we're getting hints that the government shutdown may be coming to an end. It's looking like we're heading in that direction, but we are still seeing some pressure in the markets today. You know, I'd love to just start with your thoughts on the market action we've seen lately.
The late market action that we've seen, maybe over the past 2 weeks, has been a little bit rocky, Marley. Nobody would contest that. Earnings continue to come out good, and we still see these stocks that post maybe even better than expected earnings potentially sold off in spite of those things. You've got your exceptions. On is a great example. But the reason for this is the uncertainty of what lies ahead over the next 2 months. The government shutdown, first and foremost. You know, a small blip from a government shutdown that lasts maybe a week or two is no problem. But when we get a 5-week government shutdown going on 5 weeks, people miss paychecks, uncertainty sets in, and we start to see this pullback that we're seeing at the moment. We also have a Fed decision coming up in December, and whether or not that is a cut is going to make a big difference on how the market reacts. And the Fed right now doesn't have the data that they need to make that decision as effective as they must. It's a high wire act. He's walking a tightrope here. Jerome Powell has to decide which is more important, risking inflation or risking a weaker labor market. And that uncertainty is not good for markets, as we're all aware.
Seen this uncertainty, and you mentioned the rockiness there. You know, I know we've spoken before and you were bullish heading into the end of the year. Sure. With this rockiness and this volatility that we're seeing, are you still bullish?
We're still bullish. And, you know, the thing is, I think that all of this shakes out. We've got the seasonal tailwinds of November and December. We've got a strong consumer perhaps headed into this holiday season. The data will tell, but right now the preliminary data is saying that at least starting in October, we see higher than expected holiday spending. Now, Marley, I'll tell you, there's probably going to be fewer presents under the tree, a little less wrapping paper to throw away, because people are spending more and getting less in this economy. But spending more is always a good thing in November and December, specifically for some of these retail stocks that we need to see. This broadening out must take place. So the type of uncertainty, maybe we're selling an overweight position in AI. I personally believe, and our firm strongly believes, that money will cycle back to the market. That it may set for a minute, as we've seen. It's pulled out of the market as a whole has fallen. But when we go back into the market with those dollars, we expect a broadening out, as we've seen in financials, we're seeing in energy, we're seeing in healthcare. These sectors stronger is a good thing for the market. I think it could lead 2026 into even a bull run. I'm predicting a 7,000, maybe even seeing a 7,100 S&P 500 by the end of the year. How we get there, we'll have some rocks, bumps, and certainly some pullbacks. But what we've seen is every pullback that we've seen to this point since April has been bought up, and I expect the same to happen over the next couple of weeks.
So you mentioned this tech pullback and that it could be healthy more broadly for the market, you know, bolstering some of these other sectors that need it. But I want to get your thoughts on the spending. I mean, these hyperscalers just spending trillions and trillions of dollars, and every time we get an announcement, it's either met with AI bubble concerns or a round of applause. And there doesn't really seem to be a ton of rhyme or reason for who's getting the applause and who's getting punished because they're citing bubble concerns. Is this a case where we're in a domino scenario and we watch one domino go down and then everybody falls behind them?
You read my mind, Marley. We've said this in the past. You know, it kind of reminds me of a Three Stooges skit where, you know, somebody owes somebody, and by the time it's done, there's only been $10 exchanged, but nearly $60 worth of debt has been forgotten about. This type of strategy of spend trillions in hopes that we will make perhaps billions and maybe trillions in the future, it for now has caused a significant bubble in the AI trade. I am not of the camp that I think that bubble pops, but there will be some air let out of that. It will take one announcement either way that, you know what, we might not actually make much money in this $1 trillion build out, and that is a domino that will topple the entire thing, and that could be very nasty for us. It could also take one announcement that says, hey, we figured out a way to actually make this spend profitable. And now we've got an even higher bid up in AI. So I am of the camp that we're probably in 6 or 7 when we talk innings in baseball. You know, I think we're in inning 6 or 7. And whether or not we go to extra innings is going to depend on what takes place over the next 6 to 12 months. Artificial intelligence is here to stay. It will change the world. Whether or not these companies are worth the amount of money that we have put in them as stockholders is still yet to be seen. So this broadening out is a very beneficial thing. The dominoes have been set, and our fear is that if one falls, it could topple the entire system. Now, as a firm, our primary objective is to make sure that we're making money in the upside of the market and protecting investors against the downside, because we work primarily with retirees. So we've got a little exposure to this AI. But broad exposure is the overall objective, and seeking dividends for our particular investors is the number one game that we play here at RDS Wealth. If you're a long-term investor, I wouldn't fear the AI trade, but I would be cautious if you're a short-term investor or you need to take money from that portfolio.
So if we're being cautious in this domino setup, we've got some macro uncertainty at play, we're witnessing this pullback. What are some of your stock picks right now, Dale?
You know, I'm a huge fan. If we're looking for dividends, let's talk about that for just a second. I like the ETF HDV. Now, HDV is an ETF that pays high dividends. I would also look at just maybe, for instance, if you're a long-term growth investor, looking at SPY. These ETFs gives you the type of exposure that you need in the overall market, and you're going to see some appreciation in capital, as well as dividends that those stocks that are underlying in that ETF pay. But if we're looking for long-term growth, I'm a big fan still of the Mag 7, what was up till just a few weeks ago a laggard, Apple and Amazon. I think they have a long-term game in play here, and when their AI strategy becomes laid out, I think you're going to want to be a part of those two names, Marley. I also like Royal Caribbean here. It's got a significant pullback that we're going through right now. I like it for the long term. In the short term, we could see as much as a 10 or 20% uptick if that momentum changes. But long term, Royal Caribbean has paid a steady dividend. It's nothing to write home about, but it's steady and it continues to increase. And you've got capital appreciation in a name like that. GLD, another position that we like here. Gold. I think moving to gold as a defensive tactic has always been the school of thought. But the reality is gold has some growth principles in it as well. It's got stability in a month, let's say like April of this year, but it also has some growth principles because the government is after gold right now. Governments around the world is after gold. And as we start to see yield maybe diminish a little bit in a savings account, people are going to be looking for alternatives. And what better is there than gold, the commodity? We don't believe holding the commodity is the right play here. We think holding the ETF, let's say GLD, which has the underlying commodity, you benefit from the underlying commodity's uptick in price, but you have the liquidity you need if you actually need that income. One last name, Marley, I'll give you here. In the AI play, I believe AI is going to change the world. I think some air is likely to be let out of this bubble. I don't think it pops. A name that you can buy right now on a very steep discount from its high is CoreWeave. CoreWeave has a very good chance of changing the AI race, and it could even lead us higher with quantum computing. So when you're looking at names like Rigetti or IONQ, right? When you're looking at those names, you might also look at CoreWeave. If you're a long-term player in AI or quantum computing, CoreWeave's on sale right now. I like that name.
We like sales, right? I like sales.
Like sales.
All right, Dale, thanks so much for being with us today. That's Dale Smothers, President and CEO of RDS Wealth Management. And we've got plenty more to come here.